Alright, so real quick, before we jump into this series, I just want to let y'all know something up front. For a lot of these presentations, if not most, I'll be using AI to narrate the content. But don't worry, you're not missing anything important. I personally write, listen to, and edit every script myself. So the information is still 100% me, just delivered a bit more efficiently. Now, there's a few reasons I'm doing it this way. Reason one, this lets me push out content faster and at higher quality, especially since I'm juggling other business ventures right now. Reason two is I've got a bit of a speech issue. Sometimes I stutter or slur my words more than I'd like. You probably haven't noticed because I spent a lot of time editing and re-recording, but that takes a lot of my time and a lot of energy. And reason three, if I ever need to update or tweak a script, AI narration lets me do it instantly. No need to re-record everything or block out studio time. Now, that said, you'll still see me jump in during key moments, especially when we're doing live chart work or when there's something that just hits better coming directly from me. Now, one more important thing before we get started, make sure you pause the video and download the presentation file I've linked. Take a moment to fully read through it before continuing the video. That way you'll actually understand what each part is teaching and you won't miss the context, especially in the more detailed sections. Trust me, you'll get way more out of it that way. So with all that said, let's get into this series.
Hey everyone, welcome back to the channel. Today we're diving into something that might sound complicated, but I promise to break it down super simply. Financial theories and how markets have evolved. Think of this as your crash course in understanding why the stock market behaves the way it does. We'll talk about how trading went from guys shouting on Wall Street to clicking buttons on your phone, and the three big theories that try to explain why prices go up and down. Stick around because by the end of this, you'll understand markets better than 90% of people out there. Let's get started.
All right, let's start with a time machine moment. Picture this. 20 years ago, if you wanted to buy a stock, you had to call your broker, who would then call someone on the trading floor, who would literally shout your order to another person. It was like a really expensive game of telephone. Today, you can buy Apple stock while sitting on your toilet at 3 a.m. That's the power of technology. This shift from physical trading floors to electronic trading changed everything. Suddenly, regular people like you and me could trade stocks, not just the big Wall Street firms. It's like Netflix made it so you don't need to go to Blockbuster anymore. Technology democratized investing. New players entered the game, new ways to trade were invented, and entirely new markets opened up. But here's the catch, and this is important. Just because it's easier to access doesn't mean it's easier to win.
Now here comes the reality check that nobody wants to talk about. Most regular people who start trading, they lose money. And it's not because they're stupid or unlucky. The game is literally rigged against them. Think of it like this. Imagine you're playing basketball against LeBron James, but he gets to use a trampoline, has better shoes, and practice 12 hours a day with the best coaches money can buy. That's what it's like being a retail trader competing against Wall Street institutions. These big companies spend millions on supercomputers that can make trades in microseconds, hire the smartest people from Harvard and MIT, and have access to information and tools that regular people can only dream of. Your laptop and Robinhood app? That's like bringing a water gun to a tank fight. The whole system is designed so that regular traders provide liquidity. Basically, you're the fish that feeds the sharks. I'm not saying this to discourage you, but to keep your expectations realistic. Understanding this is the first step to not getting eaten alive.
So economists, being the nerdy people they are, have been trying to figure out why markets do what they do for decades. It's like trying to predict human behavior on a massive scale, which is exactly what it is. They've come up with theories to explain whether markets are smart or dumb, whether people make rational decisions or emotional ones, and how information affects stock prices. Think of these theories like different lenses for looking at the same thing. Each one gives you a different perspective on why Apple's stock might go up or down on any given day. We're going to look at three big ones: the efficient market hypothesis, behavioral finance theory, and the adaptive market hypothesis. Don't worry about the fancy names. I'll explain each one like you're 5 years old.
The efficient market hypothesis, or EMH, is basically the theory that says markets are really, really smart. Here's the idea. Imagine the stock market is like a giant brain with millions of people feeding it information. Every time someone learns something new about a company, like Apple is releasing a new iPhone or Tesla's sales are down, that information immediately gets reflected in the stock price. So, according to EMH, by the time you hear about news, it's already baked into the price. This means that trying to beat the market by doing research or looking at charts is basically useless. You might as well throw darts at a board. It's like trying to find a $20 bill on the sidewalk in Times Square. If it was there, someone would have already picked it up, right? But here's where it gets interesting. Sometimes we see things like the dot-com bubble, where people paid crazy prices for websites that made no money, or the 2008 housing crisis. These market bubbles make people question whether markets are really that smart after all. If markets were perfectly efficient, how could people convince themselves that pets.com was worth billions?
This is where behavioral finance comes in and says, hold up, people aren't robots. Behavioral finance basically argues that humans are emotional, biased, and make irrational decisions, especially when money is involved. Have you ever held on to a losing stock because you didn't want to admit you were wrong? Or sold a winning stock too early because you got scared? That's behavioral finance in action. Think about it. When GameStop was going to the moon in 2021, was that rational? Or when people panic sell during market crashes, even though historically markets always recover? This theory says that our psychological biases, like fear, greed, overconfidence, and following the crowd, create inefficiencies in the market. When people act on emotions instead of logic, stock prices can get disconnected from what companies are actually worth. It's like when you go grocery shopping when you're hungry. You end up buying way more junk food than you need because your emotions, hunger, are driving your decisions instead of your rational mind.
Now here's where things get really interesting. In 2004, a smart economist named Andrew Lo said, "What if both previous theories are partially right?" The adaptive market hypothesis is like saying, sometimes markets are smart, sometimes they're dumb, and it depends on what's happening at the time. Picture this. Imagine you're usually a calm, rational person, but if someone jumped out and scared you, you'd probably scream and jump back. That's not rational, that's survival instinct. Markets work the same way. When things are calm and predictable, people and institutions act more rationally, and markets become more efficient. But when there's chaos, like a pandemic, war, or financial crisis, people's emotional survival mode thinking kicks in, and markets become inefficient and unpredictable. Here's the key insight. We're all different. You might panic sell when markets drop 10%, while your friend might see it as a buying opportunity. The same person might even react differently to the same situation depending on their circumstances. Maybe you're more risk-averse when you have kids to feed versus when you were single. This theory says markets are constantly evolving and adapting, just like the participants in them. It's not that people are always rational or always irrational. We're adaptive, and our behavior changes based on the environment we're in. So, what does all this mean for you as someone trying to understand markets? First, markets are complex. Anyone who tells you they have it all figured out is probably trying to sell you something. These three theories each capture part of the truth, but none tells the whole story. Second, understanding that markets are driven by human behavior, sometimes rational, sometimes emotional, can help you make better decisions. When everyone is panicking, maybe that's a good time to stay calm. When everyone is euphoric and buying everything, maybe that's a time to be cautious. Third, remember that you're competing against some of the smartest people and most powerful computers in the world. Humility goes a long way in markets. The biggest takeaway? Markets are not just numbers on a screen. They're a reflection of human psychology, adaptability, and the constant flow of information in our crazy connected world. Thanks for watching. If this helped you understand markets a little better, hit that like button and subscribe for more content that breaks down complex financial topics into bite-sized pieces. See you in the next one.
All right, so that wasn't too bad. Let me know what you guys think in the comments down below. And if you are trying to get in contact with me, you can also leave your questions in the comment section, or you can look me up on the Discord. I have Instagram, Twitter, everywhere, guys. And as you guys know, I always like to leave you with some biblical wisdom, and this is from Sirach, chapter 2, verses 1 through 2. And it says, "My child, if you come to serve the Lord, prepare yourself for testing, set your heart right, and be steadfast, and do not be impetuous in time of calamity." And for those of you that are hard to understand, if you're going to step into a greater purpose, suffering is the entrance fee. Brace yourself. Now, with that being said, guys, as I always say, strive for progress and not perfection. With that being said, I'll see you all in the next one. Peace.